Advanced Audit and Assurance, Chapter 11, Audit-Related Services. Content: 1. Review engagement. 2. Agreed upon procedures. 3. Compilation engagement. 4. Chapter review. Introduction: Competencies. Drawing conclusions and reporting. Draw conclusions and advise on the capability to report on an assurance engagement or audit engagement, including reporting findings, giving an external audit opinion, or dealing with other issues that may require inclusion in an audit report. Draft extract of a suitable assurance report or management report based on a given scenario and entity. Evaluate and apply suitable judgment on when it may be appropriate to withdraw an opinion on, or take other such appropriate action on an audit or assurance engagement. Exam context: with the trend towards increased audit exemption leading to fewer mandatory audits being performed, there is an ever-increasing market opportunity to offer non-audit services. This is the first of 2 chapters that focus on such non-audit engagements. In this chapter, students will learn how to perform review engagements in accordance with ISREs 2400 and 2410. Students will also learn how to perform related services engagements, such as agreed upon procedures and compilation engagement in accordance with ISRS 4400 and 4410. By the end of this chapter, students will be able to 1. Describe the objectives and conduct of review engagement in accordance with ISRE 2400 and 2410. 2. Describe the objectives and conduct of related services engagement in accordance with ISRS 4400 and 4410. Subtopic 1. Review engagement. Section overview. Section 1. The distinction between audit and audit-related services. Section 2. Types of review engagement. Section 3. Due diligence engagement. 4. International Standard on Review Engagement, ISRE 2400. Reporting at the end of a review engagement, International Standard on Review Engagement, ISRE 2410. Procedures for the review of interim financial information. Reporting on the review of interim financial information. Section 1.1. The distinction between audit and audit-related services. An audit is a form of assurance engagement. The objective of an audit is to enable the auditor to form an opinion as to whether the financial statements of an entity give a true and fair view. An audit is designed to provide a high level of assurance to the users of the financial statements. In contrast, audit-related services do not provide the same high level of assurance, and in some cases do not provide any assurance. Audit-related services include engagements such as 1. Review of data. Review of data are checks carried out on information prepared by another person. They provide a moderate level of assurance that the information under review is free of material misstatement. 2. Agreed upon procedures. This is an engagement where the party hiring the practitioner specifies the procedures that the practitioner should follow when performing the assignment. 3. Compilations. The practitioner is engaged to prepare information rather than to audit information prepared by someone else. For example, an accountancy firm may be engaged to prepare a tax computation for a client. Section 1.2. Types of review engagement. In a review engagement, the practitioner is engaged to review financial information or other information, but not to audit it. The work performed in a review engagement is less detailed than the work for an audit. As a result, the level of assurance provided is moderate rather than high, as in the case of an audit. A distinction is made between two types of review engagement. 1. An attestation engagement, and 2. A direct reporting engagement. Attestation engagement. To attest to something means to affirm it or vouch for it. In an attestation engagement, a practitioner is engaged to attest to something. For example, a practitioner might be engaged to attest to the fact that certain procedures within an entity have been performed in a prescribed way. The practitioner will not comment on the quality of the procedures, but will simply attest to the fact that they have been performed. Direct reporting engagement. In a direct reporting engagement, a practitioner is engaged to provide a special report on some aspect of the client's affairs. 1. The report will provide an expression of opinion, usually providing negative assurance that is made in accordance with the agreed terms of the engagement. 2. The report is prepared after the practitioner has carried out an independent examination of financial information or other information that has been prepared for use by another party. Section 1.3. Due diligence engagement. One of the most common forms of direct reporting engagement is due diligence work. This term refers to any engagement where the practitioner is engaged to make inquiries into the accounts, organizations, or activity of an entity. Due diligence work is most commonly referred to in the context of mergers and takeovers. The work involves obtaining information about the target company prior to the takeover or merger. The objective should be to find out everything that may be relevant about the target company's operation, financial performance, financial position, and future prospects. In addition, information should be gathered about the business environment in which the target company operates. The practitioner will also interview the senior management of the target company and also other key employees and possibly external third parties. Due diligence work does not involve test of controls unless the client specifically asks for this, nor does it involve substantive testing. Due diligence work is not a form of audit work. The main objective of due diligence is therefore often to provide information that will allow the client to 1. Decide whether a takeover or merger is actually desirable, and 2. If so, whether the proposed cost of acquisition is reasonable. An adverse or critical due diligence report may therefore result in 1. Abandoning a proposed takeover or merger, or 2. Reducing the offer price for the acquisition. Items to investigate in a due diligence exercise. Financial performance and financial position. The practitioner will look at the available historical financial information about the target company, such as its financial statements for the past few years. Ratio analysis will often be used to make an assessment. The practitioner will also look at the target company's management accounts, budget, and profit or cash flow forecast, and at any current business plan. Operational issues. The practitioner should also look at any operational issues in the target company that may raise questions about its value. For example, the target company might have important contracts with major customers, and the practitioner should try to find out when these contracts reach their termination date and what the probability that a contract will be renewed is. Other operational problems may be discovered, such as high rate of labor turnover or high costs incurred in meeting warranties or guarantees to customers. Management representation. Management of the takeover target may have provided representation to the potential buyer. For example, they might have given a written assurance that the target company is not subject to any tax investigation or potential litigation. Due diligence work should seek to establish that these representations appear to be correct. Identification of assets. A takeover usually results in purchased goodwill in the consolidated account. However, the takeover target may have several intangible assets that do not appear in its statement of financial position because they were internally generated assets, but which should be recognized for the purpose of consolidation. Examples are internally generated patent rights, customer list and database, and brand names. This should be identified and valued for inclusion in the consolidated statement of financial position after the acquisition. It is also useful for the management of the potential buyer to be aware of the nature and estimated value of the intangible assets that they will be acquiring. Benefits and cost of a takeover. Due diligence may also include an attempt to estimate the future benefits of the takeover, such as cost savings from synergies, such as economies of scale. Any one-off expenses such as redundancy costs and reorganization costs will have to be estimated by the potential buyer, if not by the due diligence process. Benefit of using an audit firm for due diligence. There is no reason why an accountancy firm, such as the firm's auditors, should not be engaged to carry out due diligence. Management could do some or all the work themselves. However, using an accountancy firm to do the work has two potential benefits. One, hiring an accountancy firm to do the work saves management time for the potential buyer. In addition, the practitioners assigned to do the due diligence work should have suitable experience in this type of work. For large takeover, the amount of time and resources required to carry out proper due diligence can be substantial. 2. Using a professional firm to do due diligence may help to reassure shareholders in the potential buyer or investors who will be asked to provide loan finance for the takeover that the acquisition has been properly evaluated. Section 1.4 International Standard on Review Engagement, ISRE 2400. Objectives of ISRE 2400. ISRE 2400, engagement to review financial information, sets out the objective of a review of financial statements as follows. The objective of such a review is to enable an auditor to state whether, on the basis of procedures which do not provide all the evidence that would be required in an audit, anything has come to the auditor's attention that causes the auditor to believe that the financial statements are not prepared in all material respects in accordance with an identified financial reporting framework. Note that a review requires less evidence than an audit and has an opinion that is expressed in negative terms. It gives negative assurance. Because a review engagement provides a lesser form of assurance than an audit, The work for the review will usually be limited to analytical review and other review procedures. Detailed verification work, for example, substantive tests, will not usually be carried out. This will usually mean that fewer accountancy staff but more experienced staff will be required for a review engagement than for an audit. Principles to apply to review engagement. Principles to apply to review engagement. ISRE 2400 sets out the following general principles that should be applied to review engagement. The practitioner should comply with relevant code of ethics, plan and perform the work with an attitude of professional skepticism, recognizing that material misstatements may exist in the information that is subject to review, obtain sufficient and appropriate evidence, primarily through inquiry and analytical procedures. The actual terms of a review engagement should be agreed with the client and set out in an engagement letter. Procedures for a review of financial statements. Procedures for the review of financial statements will usually include the following. 1. The practitioner should obtain an understanding of the entity's business and the industry in which it operates. 2. The practitioner should make inquiries into the entity's accounting policies, practices, and procedures, including the preparation of financial statements, material assertions in the financial statements that are subject to the review, decisions taken at board meetings and other meetings of the entity that may affect the financial statements, the completeness of the accounting records that were used to prepare the financial statements. 3. The practitioner will use analytical procedures. This should be designed to identify unusual relationship between items in the financial statement and individual items that appear unusual. Analytical procedures would include comparing the financial statements under review with financial statements for previous periods, comparing the financial statements with the anticipated results and financial position of the entity, a study of the relationship between elements in the financial statement that would be expected to conform to a predictable pattern based on the entity's past experience or normal ratio or relationship for the industry as a whole. 4. Other procedures that will usually be carried out in a review of financial statements include discussion with the company's auditors. If the audit firm is not the firm of accountants that is performing the review engagement, obtaining representation from management, considering the appropriateness of the accounting policies employed by the entity, making inquiries into subsequent events after the date of the statement of financial position, making a review of the statement as a whole. If the practitioner finds information indicating that misstatement might exist in the financial statement, the scope of the work should be extended. Section 1.5. Reporting at the end of a review engagement. The outcome of a review engagement will be a report from the practitioner. The report will be in one of two main forms, depending on whether no matters have come to the attention of the practitioner, which indicates that a true and fair view is not presented. Some matters have come to the attention of the practitioner, indicating a true and fair view might not be presented. No matters have come to the attention of the auditor. In this situation, the auditor will issue a report giving a clear expression of negative assurance. An example of such a report based on ISRE 2400 is given below. Review Report 2. We have reviewed the accompanying balance sheet of ABC Company at December 31, 20XX, and the income statement of changes in equity, and cash flow statement for the year then ended. These financial statements are the responsibility of the company's management. Our responsibility is to issue a report on these financial statements based on our review. We conducted our review in accordance with the International Standard on Review Engagement 2400. This standard requires we plan and perform the review to obtain moderate assurance as to whether the financial statements are free of material misstatements. A review is limited primarily to enquiries of company personnel and analytical procedure applied to financial data, and thus provide less assurance than an audit. We have not performed an audit, and accordingly, we do not express an audit opinion. Based on our review, nothing has come to our attention that causes us to believe that their company financial statements do not give a true and fair view or are not presented fairly in all material respects in accordance with international accounting standards. Practitioner, date, address. Note the negative assurance that is given in the report. Nothing has come to the attention of the practitioner to indicate that a material misstatement exists. Where such matters have come to the practitioner's attention, when matters have come to the practitioner's attention suggesting that a material misstatement exists, the reporting requirements are similar to those in ISA 700 for qualified external audit report. The auditor will need to 1. Describe the matters involved, 2. Assess the impact of the matter as either material or pervasive or fundamental, 3. Distinguish between disagreement and limitation on scope when presenting the opinion in the report. The following example of a report dealing with a material disagreement is based on ISRA 2400. Review reports to ... First 2 paragraphs as for the previous unqualified reports. Management has informed us that inventory has been stated at its cost, which is in excess of its net realizable value. Management's computation, which we have reviewed, shows that inventory, if valued at the lower of cost and net realizable value as required by international accounting standard, would have been decreased by X naira, and net income and shareholders' equity would have been decreased by Y naira. Based on our review, except for the effect of the overstatement of inventory described in the previous paragraph, nothing has come to our attention that causes us to believe that their company financial statements do not give a true and fair view or are not presented fairly in all material respects in accordance with international accounting standards. Practitioner, date, address. Section 1.6 International Standard on Review Engagement, ISRA 2410. ISRA 2410, Review of Interim Financial Information performed by the independent auditor of the entity, deals with a more specific topic than ISRA 2400. It deals with the review carried out by a company's external auditor of the interim financial statement, mid-year financial statement. Where companies are required to produce interim statements, the interim financial statements are not subject to a full audit. However, they are subject to a review. On the whole, general auditing principles apply to this type of review as set out below. On the whole, general auditing principles apply to this type of review as set out below. The auditing firm that reviews interim financial information, IFI, is normally the external auditor for the end of year accounts. The audit firm should 1. Comply with the same ethical requirements as it does for the main audit. 2. Implement appropriate quality control procedures. 3. Plan and perform the review with an attitude of professional skepticism. 4. Agree the terms of engagement with the client in an engagement letter. 5. Prepare documentation sufficient to support the auditor's review conclusion and to provide evidence that the review was conducted in accordance with ISRE 2410. Section 1.7. Procedures for the review of interim financial information. Procedures for the review of interim financial information (IFI) should include the following. 1. The auditor should obtain an understanding of the entity and its environment, including its internal control, in order to assess the risk of misstatement in the financial statements. Select appropriate audit procedures for the review. 2. The auditor should make inquiries and perform analytical procedures sufficient to reach a conclusion for the review. This conclusion should be about whether anything has come to the auditor's attention to indicate that the IFI has not been prepared in all material respects in accordance with the applicable financial reporting framework. As with ISRE 2400, the auditor's opinion is expressed in negative terms. 3. If any such matters come to the auditor's attention, the auditor should make additional inquiries on or perform other procedures in order to obtain more information. 4. The auditor should check that the IFI agrees or reconciles to the underlying accounting records. 5. The auditor should discover whether management has taken subsequent events into account and made an assessment of the entity's ability to continue as a going concern. 6. The auditor should evaluate any uncorrected misstatements in the IFI, both individuals and in aggregate. This is the same as for the annual audit. 7. The auditor should obtain written representation from management that they acknowledge their responsibility for internal controls. The IFI has been prepared and presented in accordance with the applicable financial reporting framework. They believe the effect of any uncorrected misstatements are immaterial, both individually and in aggregate. There has been full disclosure of all significant facts, risk assessment, possible or actual non-compliance with laws and regulations, and subsequent events. 7. The auditor should ensure that any other information issued with the interim financial information is materially consistent with the IFI. Section 1.8. Reporting on the review of interim financial information. The auditor should issue a written report on the review of the IFI. This report should consist of the following elements. Title: Review Title: Review of the IFI. Addressee: Identification of the IFI that has been reviewed. This should include the title of each of the financial statements in the set of financial statements subject to review, and the end of period date and the period covered by the IFI. A statement that management is responsible for preparing the IFI in accordance with the applicable financial reporting framework and for its fair presentation. When the IFI consists of a complete set of general purpose financial statements that should be prepared in accordance with a financial reporting framework, and the statements are designed to achieve fair presentation, the review report should include an auditor's conclusion. This conclusion should state whether anything has come to the auditor's attention that causes him to believe that the IFI does not give a true and fair view in accordance with the applicable financial reporting framework. A statement that the auditor is responsible for expressing a conclusion on the IFI based on the review that the auditor has carried out. A statement that the review of the IFI was conducted in accordance with ISRE 2410, and a statement that this review consists of making inquiries and applying an analytical procedure and other review procedure. A statement that a review is substantially less in scope than an audit conducted in accordance with ISAs. Consequently, the review does not enable the auditor to obtain assurance that he would become aware of all significant matters that might be identified in an audit. Accordingly, no audit opinion is expressed, and the auditor expresses a negative opinion rather than a positive opinion. Date of the report. Location in the country or jurisdiction where the accountancy firm practices. Signature of the auditor. Example. Shown below is an example of an unmodified report based on ISRA 2410. The report relates to IFI, comprising a complete set of general purpose financial statements prepared in accordance with IFRS. In other words, the report relates to a review of IFI that uses a financial reporting framework designed to achieve fair presentation. Note that ISRA 2410 has not yet been updated for the changes in terminology introduced by the revision of IAS 1 presentation of financial statements. Report on review of interim financial information. Appropriate addressee. Introduction. We have reviewed the accompanying balance sheet of ABC entity as of March 31, 20XX, and the related statement of income, changes in equity, and cash flow for the 3 months period then ended, and a summary of significant accounting policies and other explanatory notes. Management is responsible for the preparation and fair presentation of this interim financial information in accordance with indicate applicable financial reporting framework. Our responsibility is to express a conclusion on this interim financial information based on our review. Scope of review. We conducted our review in accordance with International Standard on Review Engagement 2410, review of interim financial information performed by the independent auditor of the entity. A review of interim financial information consists of making inquiries, primarily of persons responsible for financial and accounting matters, and applying analytical and other review procedures. A review is substantially less in scope than an audit conducted in accordance with international standards on auditing, and consequently does not enable us to obtain assurance that we would become aware of all significant matters that might be identified in an audit. Accordingly, we do not express an audit opinion. Conclusion. Based on our review, nothing has come to our attention that causes us to believe that the accompanying interim financial information is not prepared in all material respects in accordance with applicable financial reporting framework, including a reference to the jurisdiction or country of origin of the financial reporting framework, when the financial reporting framework used is not International Financial Reporting Standard. Auditor, date, address. A qualified or adverse opinion should be given where the auditor or accountant believes that the IFI has not been prepared in accordance with the applicable financial reporting framework. If a limitation on scope is imposed, the auditor should 1. Communicate to the appropriate level of management and to those charged with governance the difficulty the auditor has in reaching an opinion, and 2. Consider whether he can issue a report. If there are uncertainties surrounding going concern, then the auditor should modify his report in a manner consistent with ISA 570 going concern.